Alright, so you're probably thinking, taxes? Ugh, I've got enough on my plate without worrying about that. But here's the thing, 2026 is a game changer when it comes to tax planning. Let me walk you through the biggest shifts and how to stay ahead of the game. Think of it like a roadmap. Let's start with the basics. The 2026 tax brackets. If you're single, your standard deduction is $13,500. And if you're married, it's $27,000. That means if your income is under those thresholds, you might not even need to file a return. But here's where it gets tricky. Those numbers are higher than 2025, so if you're in a lower tax bracket, you might be eligible for more deductions. For example, a single filer with $50,000 in income in 2026 would fall into the 12% bracket, but if they itemize deductions, they could save thousands. Wait, let me break that down. Let's say someone has $10,000 in mortgage interest and $5,000 in charitable donations. If they itemize, that's $15,000 in deductions, which would reduce their taxable income by that amount. But if they take the standard deduction, they're only saving $13,500. So itemizing could save them $1,500. But here's the catch. You have to track all those expenses. That's why it's important to keep receipts and records. Now, let's talk about the 2026 child tax credit. If you have a child under 17, you could get up to $2,000 per child. But here's the twist, it's phased out for higher incomes. For example, if you make $75,000, you might get $1,500. But if you make $100,000, you might only get $500. So it's not a one-size-fits-all deal. Let me give you a real example. Sarah, a single mom with 2 kids, made $75,000 in 2025. She got $1,500 per child, totaling $3,000. In 2026, her income increased to $85,000. She now gets $1,200 per child, totaling $2,400. That's a $600 drop. But here's the catch. She also has a $529 college savings plan. If she uses that, she might qualify for the American Opportunity Credit, which is up to $2,500 per student. So even if the child tax credit is reduced, she can offset it with other credits. Now, let's move to retirement accounts. The 2026 IRA contribution limit is $10,500 for individuals under 50 and $14,000 for those over 50. But here's the thing. If you're in a higher tax bracket, contributing to a Roth IRA might be better. Let me explain. If you're in the 22% tax bracket, you pay 22% on your contributions now, but you pay 0% on withdrawals later. That's a huge advantage. For example, if you contribute $10,500 to a Roth IRA, you're paying $2,300 in taxes now. But in retirement, you'll withdraw that money tax-free. So if you're 40 and in a 22% bracket, that's a smart move. But if you're in a lower bracket, a traditional IRA might be better. Let's say you're in the 12% bracket. You contribute $10,500, pay $1,300 in taxes now, but in retirement, you'll pay 12% on withdrawals. That's a 12% tax rate, which is better than 22%. So it's all about your current tax bracket and retirement goals. Now, here's a tip. If you're over 50, you can contribute an additional $1,000 to your IRA. That's called a Roth IRA sophomore contribution. So if you're 55, you can contribute $11,500. That's a big chunk of change. But here's the catch. Those contributions are subject to the same rules as regular contributions. So if you're in a higher bracket now, it's worth it. Now, let's talk about tax-deferred accounts. 401k, S, and 403b. S have contribution limits of $22,500 for 2026 and $30,000 if you're over 50. But here's the thing. If you're not maxing out your 401k, you're missing out on a lot of tax benefits. Let's say you earn $100,000 and contribute $22,500 to your 401k. That reduces your taxable income by $22,500, which could lower your tax bracket. For example, if you're in the 22% bracket, you save $5,000 in taxes. But if you're in the 32% bracket, you save $7,200. That's a huge difference. So even if you're not in a higher bracket, contributing to a 401k is a win. But here's the catch. If you're self-employed, you can contribute to a SEP IRA or a solo 401k. Those have higher contribution limits. For example, a SEP IRA allows you to contribute up to 25% of your income, up to $66,000 in 2026. That's a massive tax deduction. So if you're self-employed, you should definitely consider those options. Now, let's talk about tax loss harvesting. If you have investments that have dropped in value, you can sell them to offset capital gains. But here's the thing. The 2026 capital gains tax rate is 30% for those in the highest bracket. So if you sell a stock that's down 20%, you can use that loss to reduce your taxable income. Let me give you an example. If you have a $50,000 capital gain and a $10,000 capital loss, you can deduct the $10,000 loss from your gain, reducing your taxable gain to $40,000. That saves you $12,000 in taxes. But here's the catch. You can only do this once per year, and you have to hold the investment for at least a year to qualify for long-term capital gains rates. So if you're in a higher bracket, this is a must-do strategy. Now, let's move to tax-efficient investing. If you're investing in ETFs, look for those with low turnover. High turnover ETFs generate more capital gains, which can push you into a higher tax bracket. For example, a high turnover ETF might have a 15% turnover rate, generating 15% in capital gains. That's a lot to tax. But a low turnover ETF might only have a 5% turnover rate, generating 5% in gains. That's a big difference. So if you're looking for ETFs, prioritize those with low turnover. Another tip, use Roth conversion strategically. If you're in a lower tax bracket now, converting a traditional IRA to a Roth IRA can save you money in the long run. Let's say you have $100,000 in a traditional IRA and you're in the 12% tax bracket. You pay $12,000 in taxes now, but in retirement, you'll pay 0% on withdrawals. That's a massive tax savings. But if you're in a higher bracket, it might not make sense. So it's all about timing and your current tax situation. Now, let's talk about tax software. If you're not using tax software, you're missing out on a lot of benefits. TurboTax, H&R Block, and TaxAct are all great options. But here's the thing, they all have different features. For example, TurboTax has a free version for simple returns, but if you have more complex deductions, you might need to pay for the deluxe version. But here's the catch. If you use tax software, you can get free tax preparation services, which can save you money. Plus, they'll flag any errors or missed deductions. So even if you think you're good with taxes, using software is a smart move. Now, let's wrap up with a real case study. Take Mark, a single filer with $75,000 in income, $10,000 in mortgage interest, and $5,000 in charitable donations. In 2025, he itemized and saved $1.5 thousand. But in 2026, the standard deduction is $13.5 thousand. So he could save $13.5 thousand by taking the standard deduction. Wait, that doesn't make sense. Let me clarify. If he takes the standard deduction, he saves $13.5 thousand. If he itemizes, he saves $15,000. So itemizing is better. But here's the catch. He needs to track all his deductions. If he doesn't, he might miss out. So he starts using tax software, which helps him track everything. He also contributes $10.5 thousand to his Roth IRA, saving $2.3 thousand in taxes now. In retirement, he'll get that money tax-free. Plus, he uses tax loss harvesting to offset $5,000 in capital gains, saving $1.5 thousand in taxes. So in total, he saves over $6,000 in taxes by implementing these strategies. That's the power of proactive tax planning. So what's the takeaway? Stay ahead of the game by understanding the 2026 tax brackets, maximizing deductions, leveraging credits, contributing to retirement accounts, using tax loss harvesting, investing in tax-efficient ETFs, and using tax software. If you do these things, you'll be way ahead of the game. And remember, tax planning is about more than just numbers. It's about making smart decisions that save you money and give you peace of mind. So if you're looking for more tips or want to dive deeper into any of these strategies, hit the like button, subscribe, and leave a comment below. I'm always here to help you stay ahead of the game.